Tiger 21 is a private invite-only networking group for ultra-high net worth individuals, and it releases quarterly reports on where its members are holding their assets. According to the third quarter data, members are putting their cash to work, favoring private equity, and they're also increasing their crypto holdings. Here to talk more about the report, Michael Sonnenfeldt, Tiger 21 founder and chairman. Thank you so much for being here.
Thank you.
This is a fascinating group of folks, and it's interesting to learn where they're putting their money. And it sounds like they're taking on risk, or at least they didn't in the third quarter. So why do you think they're doing that, and how did it manifest itself? Well,
first of all, we have a risk-on portfolio across our 1,700 members, $250 billion. 79% is split between private equity, that's the first at 30%, public equity at 23%, and real estate at 26%. So long-term, that's pretty bullish. But one of the things that's going on is crypto has recently doubled over the last year from about 1% to 2%. That may not seem like a lot, but when you're talking about $250 billion, that's $5 billion of crypto. And in every meeting, people are talking about, is this a new security asset? Will this be a place, a safe haven like gold? And so in our meetings across the globe, people are really comparing notes on, it's not so much crypto, it's mostly Bitcoin, but not exclusively. Obviously, we have some of the great crypto traders, and they go into all the other varieties of digital currency, but Bitcoin is the big kahuna.
Have there been any other interesting changes over the past several years besides that sort of increase in interest in crypto?
Sure. The long-term biggest change is private equity moving from 10% to 30% over a decade. So that's the biggest systemic change. The other one is that hedge funds used to be about 6-7%. They're now 2%. Hedge funds are basically dead as a doornail. And that's mostly because our members have learned that hedge funds on average, particularly those investing in public stocks, have a hard time beating the averages, and they cost a lot more. So you're better off in the index funds. Fixed income, quite low. And as I say, crypto coming up a little. That's the one that, even though it's only 2%, that's the most talked about asset right now.
And do they see those returns as better in private equity? Because that stuff has high fees as well.
Well, our members are not going into the mega funds. They're both going into smaller mid-cap funds and making direct investments. When you're some of the world's greatest entrepreneurs, already they're 1 in 10,000 by accomplishment. They can roll up their shirt sleeves, they can look at a building, they can buy a building directly, they can look at a small company. They want to be on the board of a small company where they're the first to hear about a problem so they can help solve it, not the last. When you're a public stockholder, you're the last to hear about a problem, and then it's too late.
Right. And we were talking a little bit during the break, and I think what is notable about these folks, I think people watching, they always want to know how people make their money because they want to make money also. What's interesting here is even though these people are building onto their wealth by investing, many of them, as you told me, that's not how they sort of initiated their great wealth build, right?
So we are a particular group. We're all entrepreneurs who have mostly had a liquidity event. The great wealth in America is created by entrepreneurs, not by investors. When you've created wealth, you want to preserve it, and therefore you become an investor. But the rates of return you'd have to earn to become a Tiger member, as an example, over a 20 or 30-year period would be over 20%, even more than Warren Buffett. But nobody can sustain it for as long as he did. But 5, 10, 20 years, you can build an extraordinary amount of money. Once you have that much money, you want to become more conservative because you want to preserve it. And now you're earning lower rates of return, but with much less risk.
So when we're talking about things like we're watching in the market, and we're talking about all the time about, is AI in a bubble? Have some of these tech valuations gotten overextended? When you talk to your members, what are you hearing from them about that?
You know, we have groups, 60 across North America, 60 cities. We're about 100 groups across North America. You meet every month, and you say, what happened in the last month that was most important? And these are all peers, so they're not selling, they're helping each other. What's going on in the markets is they're saying, where are things going? But let's not overreact in the moment. We're not day traders. We're people who are investing for 10 and 20 years. In order to create wealth, you've had to be investing for 20 years if you're building a company. It's not a day trader's market. So our members are predisposed to long-term investments. And that's why I say when we're 79% long invested, that's a midterm bet, not a bet about whether the market will go up or down in the next day or two.
And so that would imply that they are seeing value in some of these longer-term AI infrastructure build-out projects.
Absolutely. Well, depending on where you think AI is going, you have all of the equipment, you have the chip manufacturers, not just NVIDIA, maybe Micron is undervalued, but then you have all the energy providers. So there's a long chain of investments that you could make if you're a believer in AI.
Michael, I'm curious, is there, what's the sort of age dispersion among your members? And is there also a difference in how they're approaching all of this?
There is. It's a great question because a decade, maybe 2 decades ago, we're now 26 years, our average age was around 59. Today it's closer to 51. And what does that mean? It means that you can, in a global economy, a frictionless economy, particularly with the internet, you can grow great wealth in a much shorter period of time. So 20 years ago when you joined Tiger 21, you had finished your wealth building days and now you had to build a business over 20 years, now you're going to retire. Today you can create that wealth if you're really lucky in 5 or 10 years, and you might be 40 years old, and you're going to do it again and again. So 20 years ago, our members were thinking of themselves as passive investors. Our members now, after they sell a business, are thinking of doing it again.
Wow, okay, so is there a piece of advice that you would give people who are watching who want to emulate some of these folks in terms of building those businesses?
It's all about the basics. You know, if you get distracted by momentum and all of these stories, the story stocks, but if you want to know basics, you know, you can make an extraordinary amount of money owning a Dunkin' Donuts or any of the franchises, Wendy's or, you know, whichever the quick service restaurants are. It's slow and steady. Some people think it's like watching the paint dry, but over the long period of time, you can really create great wealth with less risk if you're a terrific entrepreneur. It's not so easy to do.